Today, we are diving into one of the biggest financial mysteries of our time, the 2008 financial crisis. It's a wild story, full of complex financial jargon and some, well, disastrous decisions. But we're going to break it all down, step by step, and really get to the bottom of how a boom in the U.S. housing market brought the entire world to the edge of collapse. Let's get into it. So, first, let's just set the scene. I want you to picture the fall of 2008. The news headlines are just screaming disaster, stock markets are in an absolute freefall, and there's this palpable feeling of panic in the air. This wasn't just, a bad day on Wall Street. The whole global economic system was genuinely teetering on the brink. And look, that is not an exaggeration. We are talking about a moment where the very plumbing of the world's economy, the system that lets businesses pay their employees, that lets you get a loan, it just stopped. It froze. The stakes, honestly, could not have been higher. And the scary part? Look how fast this all happened. These weren't just random, isolated events. They were dominoes falling, one after another, faster and faster. Bear Stearns goes under in March. Then, in one single catastrophic month, September, the mortgage giants Fannie Mae and Freddie Mac are taken over by the government, Lehman Brothers files for the biggest bankruptcy in U.S. history, and the massive insurer AIG needs an emergency bailout to survive. The result? The credit markets, the engine room of the economy, froze solid. So that's the big question, right? How on earth did a problem that seemed to be about American houses spiral into a crisis that threatened to take down the entire global economy? Well, to answer that, we have to look under the hood. We need to understand the tools and, really, the machine that Wall Street had built. So think of this like a crime scene. Before we can figure out what happened, we need to understand the tools that were used. So let's quickly cover just a few basic financial ideas that are absolutely essential to this story. Stick with me here, because this is really where it all begins. Okay, first up, the difference between real and financial assets. It's actually pretty simple. Real assets are the stuff, factories, buildings, your house. They have real, tangible value. Financial assets, on the other hand, are the paper claims on the income from that stuff. Things like stocks, bonds, and, super important for our story, mortgages. And within those financial assets, you've really got three main characters in our story. You've got debt, which is just a loan. You've got equity, which is a slice of ownership. And then you have the real wild card, derivatives. These are complex contracts whose value comes from some other asset. And their main purpose? To move risk from one person to another. Now keep that one in the back of your mind. It is a huge piece of this puzzle. All right, so we've got the building blocks. Now let's look at the incredible and kind of scary machine that Wall Street built with them. This is the story of how a simple home loan was turned into a complex global product through something called securitization. And this right here shows the huge fundamental shift. You see, in the old days, your local bank gave you a mortgage, and then they kept it. They originated-to-hold. That meant they really, really cared if you paid it back. But in this new model, Originate-to-Distribute, that bank made the loan and then immediately sold it off. The risk and the responsibility was now someone else's problem. So the incentive changed. It wasn't about making a good loan anymore. It was just about making more loans to sell. And this pipeline shows you exactly how that worked. Step 1, you get a mortgage. Step 2, your bank immediately sells it to a big investment bank. Step 3, that investment bank bundles your mortgage with thousands of others, creating this giant pool. And finally, step 4, they slice up that pool and sell the pieces to investors all over the world as something called a mortgage-backed security, or MBS. Just like that, your simple home loan is now a complex financial product. And this is where things take a really dangerous turn. See, at first, this machine was processing safe, high-quality mortgages, but the global demand for these MBS products was absolutely massive, and the fees for creating them were gigantic. So Wall Street needed more mortgages to feed the machine. They started using riskier and riskier loans, subprime loans, given to people with shakier credit. The quality of the raw material was getting worse and worse, but the machine just kept running faster. Okay, so we know how the machine is supposed to work. Now, let's pop the hood and find out exactly why it exploded. Because hidden deep inside this new financial system were several, fatal flaws. It actually got even more complicated with these things called CDOs, or Collateralized Debt Obligations. Investment banks would take those pools of mortgages, including all the risky subprime ones, and slice them up again into different layers, or tranches based on risk. And here's the crazy part. They claimed they could magically create super safe slices that deserved the highest possible credit rating, AAA. And the rating agencies, who were getting paid by the very banks creating these things, were more than happy to stamp that AAA rating on them.
But here's the thing, the ratings. They were just plain wrong. The risk that was supposedly removed from those safe slices was still there, hidden in plain sight.
So why were they so wrong? Well, because the entire system, all those complex models, it was all built on one single deeply flawed assumption. Everybody, and I mean everybody, believed that while a few people might default on their loans here and there, the entire U.S. housing market would never, ever fall all at the same time. That belief was the system's single point of failure. Now, to make investors feel even more secure about buying these risky products, Wall Street sold them something called a credit default swap, or CDS. The easiest way to think about it is just as an insurance policy. If your CDO investment went bad, the CDS was supposed to pay you back. But, and this is the other killer flaw, that insurance policy? It was basically worthless. The companies selling all this insurance, most famously AIG, didn't have anywhere near enough money set aside to actually pay the claims. It was like they sold fire insurance to every single building in a city, but only had enough cash to cover one house fire. When the whole market went up in flames, they couldn't pay. Okay, so let's put all the pieces together now. We've got flawed ratings on confusing products, all built on the fantasy that home prices only go up, and then backed by insurance that wasn't really insurance at all. Now, let's go back to that timeline and watch how the dominoes fell. See how it all connects? Starting in 2004, interest rates start to creep up, which makes those risky mortgage payments unaffordable for many homeowners. By 2006, the housing bubble finally pops and prices start to fall. Then, in 2007, people start defaulting on those subprime mortgages in huge numbers. And by 2008, all those investments that were rated super safe are revealed to be toxic junk, which causes a wave of panic that freezes the entire financial system.
And this brings us to the terrifying concept that everyone learned about in 2008, systemic risk. It's basically financial contagion. Because all these banks were connected and nobody knew who was holding the bad loans, they just stopped trusting each other. They stopped lending to each other. The whole system seized up, threatening not just a few Wall Street firms, but everybody.
The world did manage to pull back from the brink, but the crisis left some incredibly deep scars. So what were the big lessons here? What did we learn from this absolute near disaster? When you boil it all down, it was really a perfect storm. It started with this false belief about housing prices. That was made worse by bad ratings from agencies that should have known better. You had products specifically designed to hide risk, insurance that couldn't pay out, and the system so interconnected and overloaded with debt that one failure could, and nearly did, bring the entire thing crashing down. To stop a complete and total repeat of the Great Depression, the U.S. government and central banks all over the world had to step in with absolutely unprecedented bailouts. We're talking trillions of dollars just to stop the bleeding and get money flowing through the system again. And that, of course, leaves us with the big, lingering question. The system was rescued from total collapse, sure, but were the fundamental problems actually fixed? Are we any safer today? Well, that is the billion-dollar or maybe trillion-dollar question that we're still debating. Thanks for digging into this with me today.